In an era of soaring public debt, persistent inflation, and mounting geopolitical risk, the world's largest economy is quietly rewriting the rules of retirement and wealth preservation. This analysis argues that traditional U.S. savings models built for low debt and stable currencies are colliding with a new age of monetary debasement and financial repression. It examines how pensions became individual risk, why bonds and tax-deferred accounts now face systemic threats, and how policy, inflation, and currency dynamics are reshaping long-term security. To understand what this means for the American worker, we begin by dissecting the hidden vulnerabilities in today's retirement system. The forensic backdrop, 1974 versus 2026. If you want to find the exact moment the American worker was sentenced to a working retirement, you look at the Employee Retirement Income Security Act of 1974. Before this, the social contract was simple, almost feudal. You gave 40 years of your life to a corporation or the state, and in return, they provided a defined benefit, a pension that lasted until the day you died. The risk of investment failure, inflation, and longevity was held by the institution. But in 1974, the math changed. The institutions realized that in a world of fiat currency and expanding debt, they could no longer hedge the future. The result? The Great Shift. The burden of survival was offloaded onto the individual retirement account. We were told this was financial freedom. In reality, it was a strategic retreat. The illusion of the ledger. Most people look at their IRA statement and see a number. They see $500,000 or $1 million and feel a sense of security. This is the first mistake of the amateur historian. A number in a ledger is not wealth. It is a claim on future energy. When the independent financial historian performs an autopsy on the retirement system, we don't look at the nominal price, we look at the purchasing power. If your IRA grows by 7% a year, but the real-world inflation of healthcare, energy, and quality food is 10%, your fortress isn't growing. It is being besieged by a silent army of termites. The 401 and the IRA were designed in an era of 2% inflation and 5% interest rates. In the era of the monetary gulag, where debt-to-GDP ratios exceed 120%, those old blueprints are not just obsolete, they are dangerous. The state as a predatory partner. We must address the traditional IRA for what it truly is, a deferred tax liability. When you contribute to a traditional IRA, the government is not giving you a tax break. They are entering into a joint venture with you where they decide to split 30 years from now. Look at the forensics of national debt. When a government reaches the event horizon of debt where interest payments exceed the defense budget, they have only 3 levers. Print, destroying the value of your savings. Default, destroying the system. Confiscate, raising taxes. By holding a traditional IRA, you are leaving your fortress gates unlocked. You are betting that a bankrupt government in 2045 will be more generous with tax rates than they are today. History suggests this is a mathematical impossibility, the fatal flaw of linear thinking. The average retiree planning for a 30-year horizon makes one catastrophic assumption, that the unit of account will remain a stable measuring stick. This is the financial equivalent of a carpenter trying to build a house with a ruler that shrinks by a quarter inch every month. By the time you reach the roof, nothing fits and the structure collapses. In the world of the independent financial historian, we don't look at average returns. We look at the currency clock. Every fiat currency in history has a half-life. Since the tether to gold was severed in 1971, the US dollar has lost over 85% of its purchasing power. If you are 35 years old today, planning to retire at 65 and live until 95, you are looking at a 60-year window. The forensic reality. There is no 60-year period in the history of paper money where a currency has maintained even 20% of its value. To build a retirement fortress on a 30-year horizon using paper-denominated assets is to build on a foundation of quicksand. The math of the silent tax. Most IRA blueprints celebrate a 7% annualized return. But let's perform an autopsy on that number. Nominal return, plus 7%. Real inflation, shadow stats, basket of necessity, negative 9%. Tax liability future projection, negative 25% to negative 40%. Negative 4 to 6%. When your real yield is negative, you aren't investing, you are paying a fee for the privilege of holding a dying currency. If you have $1 million in your IRA today, and the currency clock continues its current trajectory of a 3 to 5% annual debasement, the historical average for late-stage empires, that $1 million will have the purchasing power of roughly $300,000 in today's terms by the time you actually need to spend it. This is why the safe path, holding cash, CDs, or long-term government bonds is actually the most reckless path you can take. In late-stage monetary regimes, safety is a hallucination. The Triffin dilemma and the retirement perimeter. We must address the reserve currency trap. As the world's reserve currency, the U.S. is forced to run massive deficits to provide liquidity to the global system. This is known as the Triffin dilemma. Eventually, the debt required to maintain this system becomes so large that the interest payments consume the tax revenue. We reach that event horizon in 2024. When a nation can no longer pay its debt through productivity, it turns to financial repression. This is a surgical term for keeping interest rates below inflation. It is a deliberate policy to liquidate the wealth of the saver, to pay off the debts of the state. Your IRA is the primary target for this repression. By forcing you to hold safe domestic assets, the state ensures that your retirement fund is the liquidity they use to keep their own lights on. The 30-year volatility ghost. On a 30-year horizon, black swan events are not rare, they are certainties. Since 1900, every 30-year window has included at least one world-changing monetary reset. 1914 to 1944, the end of the gold standard and the birth of Bretton Woods. 1944 to 1974, the rise and fall of the dollar gold peg. 1971 to 2001, the birth of the petrodollar and the great inflation. 2001 to 2031, the birth of the digital debt era and the projected Great Reset. If your IRA blueprint assumes that the next 30 years will look like a peaceful extension of the 1990s, you are ignoring the autopsies of every empire that preceded us. The currency clock is ticking toward midnight. A fortress is not built by ignoring the storm, it is built by calculating the wind speed and reinforcing the walls before the first gust hits. In Chapter 3, we will examine the only legal secret room left in the fortress, the Roth Bastion, and why the traditional IRA is increasingly looking like a Trojan horse. The traditional IRA, a partnership with a predatory state. Most financial advisors market the traditional IRA as a gift from the government, a way to save on taxes today. But when we perform an autopsy on this claim, we find a much darker reality. A traditional IRA is not a savings account. It is a deferred tax liability with an unknown price tag. When you contribute to a traditional IRA, you are entering into a legally binding partnership with the Internal Revenue Service. In this partnership, you provide 100% of the capital, you take 100% of the investment risk, and the IRS gets a cut of the profits. The catch? The IRS reserves the right to decide what their percentage will be at the end of the 30-year term. From a historical perspective, this is financial insanity. You are betting that a government facing $38 trillion in debt, $200 trillion in unfunded social liabilities, and a declining global reserve status will be more generous with tax rates in 2050 than they are today. History tells us that when empires go bankrupt, they don't lower taxes, they strip mine the wealth of the middle class. The Roth Bastion, buying your immunity. The Roth IRA represents the only legitimate secret room within the retirement fortress. By paying the tax today at historically low rates, you are effectively buying tax immunity. In the math of survival, a dollar you own 100% of is infinitely more powerful than a dollar you share with a bankrupt partner. Think of the Roth IRA as a prepaid defense system. Once the money is inside the bastion, it is shielded from the two greatest predators of wealth: future income tax hikes. As the state becomes more desperate for revenue, the tax brackets of today will look like a paradise compared to the emergency levies of tomorrow. Required minimum distributions. The traditional IRA has a kill switch called the RMD. At a certain age, the government forces you to open the gates and liquidate your assets so they can collect their tax. The Roth IRA has no such requirement. It allows the fortress to remain sealed, allowing your wealth to compound indefinitely or be passed to the next generation untaxed. The forensic evidence, 1913 to 2026. To understand why the traditional IRA is a trap, we must look at the tax autopsy of the 20th century. In 1913, the top federal income tax rate was a mere 7%. By 1944, to fund the machinery of war and debt, that rate skyrocketed to 94%. We are currently in a lull of historically low tax rates, but the fiscal forensics suggest this is the calm before the storm. When the interest on the national debt exceeds the defense budget, as it did in 2024, the government enters the final extraction phase. They will look at the trillions of dollars sitting in traditional IRAs, 400 and wonks, as a giant untapped pool of liquidity. Whether through direct tax hikes, wealth taxes, or mandatory conversions into government bonds, the traditional IRA is the most exposed part of your perimeter. The Roth bastion, by contrast, is a closed loop. It is much harder, politically and legally, for a state to re-tax money that has already been settled. The strategic blueprint, the conversion ladder. The independent financial historian doesn't just identify the trap, we build the exit. For those already stuck in the traditional trap, the Roth conversion ladder is the tactical maneuver required to move assets into the bastion. This involves paying the ransom, the tax now, in controlled increments to move your wealth across the border into the Roth perimeter. It is a painful short-term cost for a long-term strategic advantage. In a world of monetary decay, the goal is to minimize your surface area of confiscation. Every dollar moved into a Roth account is one less dollar the state can seize to pay for its own mismanagement. The 60/40, relic of a dead era. For 4 decades, the gold standard of retirement planning was a 60/40 portfolio. 60% equities for growth, 40% bonds for safety. In the disinflationary world of 1982 to 2020, this was a masterpiece of engineering. As interest rates fell from 15% to 0%, bond prices surged, providing a cushion whenever stocks faltered. But when we perform a forensic autopsy on the current macro environment, we find that the 60/40 portfolio isn't just underperforming, it is a death trap. In the era of the monetary gulag, where inflation is used as a tool of state survival, the safety of bonds is a mathematical illusion. Bonds are fixed income securities. The fixed part is the problem. When the currency is being debased by 5%, 10%, or 15% in real terms, a bond paying 4% is a certificate of guaranteed confiscation. You are voluntarily handing your wealth over to be incinerated. The bond trap, becoming the state's exit liquidity. We must address the uncomfortable truth. Government bonds are nothing more than IOUs from a bankrupt entity. When you hold a treasury bond in your IRA, you are lending money to a government that has no intention and no mathematical ability to pay you back in currency with equivalent purchasing power. Historically, when debt to GDP ratios exceed 120%, governments engage in financial repression. They force interest rates to stay below the rate of inflation. This is a surgical transfer of wealth from the bondholder to the debtor, the state. In this scenario, the 40% of your portfolio meant to protect you is actually the exit liquidity for the government's fiscal mismanagement. The 60/40 grave is dug with a shovel of negative real yields. Pricing power, the only equities that survive. If the 40% bonds is dead, the 60% equities must be reevaluated with forensic precision. In a period of high inflation and currency decay, not all companies are created equal. Most businesses will see their margins crushed by rising input costs and falling consumer demand. To build a fortress, your IRA must focus on pricing power equities. These are the toll bridges of the global economy. We look for companies that possess low capital intensity. They don't need to rebuild massive factories every year at inflated costs. Provide essential utilities, services that people cannot cut from their budget no matter how high the price goes. Command high barriers to entry, monopolistic or oligopolistic positions that allow them to raise prices faster than the central bank can print money. In the 1970s, the last great era of stagflation, only a handful of sectors maintained real value. Those who owned quality were protected. Those who owned growth at any price were liquidated. Integrating hard assets. The final component of the Chapter 4 blueprint is the move from paper assets to hard assets. A fortress built entirely of digital entries in a brokerage account is vulnerable to systemic glitches and counterparty risk. The independent financial historian advocates for the integration of physical insurance within the retirement perimeter. This means utilizing the self-directed IRA, which we will autopsy in Chapter 5, to hold physical gold and silver, the only financial assets that are not someone else's liability. They have a 5,000-year track record of surviving 100% of currency collapses. Income-producing real estate, assets that provide calorie and shelter value, things that humans will always need regardless of the value of the dollar. If your IRA doesn't contain assets that exist outside the digital ledger of Wall Street, your fortress is merely a projected image on a screen. True structural integrity requires weight. It requires assets that the government cannot print and the banking system cannot delete. The brokerage illusion. You don't own what you think you own. In the autopsy of the modern financial system, one of the most chilling discoveries is the reality of beneficial ownership. When you look at your IRA on a screen at a major brokerage, you assume you own those shares of Apple or that gold ETF. The independent financial historian must correct this misconception. You do not own the asset. You own a contractual claim against a broker who has a claim against a custodian who has a claim against a central depository like the DTCC. This is a chain of custody that works perfectly in peacetime, but in a systemic liquidity crisis, stage 5 collapse, this chain becomes a series of weak links. The self-directed IRA is the only mechanism that allows you to break this chain. It allows you to move from being a beneficial owner to a direct controller. By establishing a specialized SDRA, you gain the legal authority to move your retirement capital out of paper-based proxies and into the physical perimeter. Breaking the Wall Street grid. Why does the state, in partnership with Wall Street, make it so difficult to self-direct? The answer is found in the forensics of control. As long as your IRA is trapped in a traditional brokerage, your wealth is liquidity for their system. They can lend your shares to short sellers, use your cash for overnight repo markets, and charge you fees for the privilege of holding assets that they ultimately control. A self-directed perimeter allows you to diversify into the real economy. Physical precious metals. Not a paper gold ETF like GLD, which is merely a debt instrument, but actual bars and coins held in a secure non-bank depository. This is the only asset that is not someone else's liability. Private equity and small business. Investing in local, productive entities that provide goods and services. These businesses are often shielded from the irrationality of the public markets. Real estate and farmland. As we analyze in the 5 assets autopsy, land is the ultimate calorie and shelter generator. An SDIRA allows your retirement fund to own the deed to a farm or a rental property, providing a dual hedge of capital appreciation and real-world utility. The checkbook control maneuver. The most advanced version of this fortress is the IRA LLC, or checkbook control IRA. In this structure, your IRA owns a limited liability company, and you act as the manager. This is the Special Forces unit of retirement planning. It gives you the tactical agility to deploy capital instantly. If the banking system freezes, or a specific asset class becomes available at a blood-in-the-streets discount, you do not need to wait for a custodian's approval or a broker's clearance. You simply write a check from the LLC account. However, with great power comes forensic responsibility. The IRS has strict prohibited transaction rule. You cannot use the IRA's money to buy a house you live in, nor can you pay yourself a salary from it. The SDIRA is a fortress meant for the future version of you. Any self-dealing today will cause the walls to be breached by the IRS, resulting in the immediate liquidation of the account and a catastrophic tax event. Counterparty risk, the ghost in the machine. We live in an era of cyber risk and geopolitical de-risking. If a major conflict or a systemic hack shuts down the digital ledgers of the NYSE or NASDAQ for 10 days, what happens to your paper wealth? By moving a portion of your IRA into a self-directed perimeter, you are eliminating counterparty risk. When you own a deed to a piece of land or a physical bar of gold in a vault, you are not dependent on the solvency of a bank or the uptime of a server. You have moved your retirement from the abstract world of finance into the concrete world of history. A fortress is only as strong as its most vulnerable dependency. If your retirement depends on a 24/7 internet connection and the goodwill of a Tier 1 bank, your perimeter is not secure. The SDIRA is the only way to build a wall that the ghost in a machine cannot haunt. The wait-and-see fallacy. In the study of financial history, the most common cause of wealth, death, is not a lack of intelligence, but a lack of decisiveness. Most people observe the warning signs, the mounting debt, the currency debasement, the demographic decay, but they fall victim to the wait-and-see fallacy. They wait for a signal from the mainstream media or confirmation from the very institutions that profit from their inertia. By the time the signal is clear enough for the average person to understand, the fortress is already under siege. In Weimar, Germany, the transition from expensive bread to worthless money didn't take decades. It took months. In Lebanon, the banking haircut happened over a weekend. The cost of inaction is not just a lower return, it is the complete annihilation of your life's work. The Weimar middle class. We must perform an autopsy on the German middle class of the early 1920s. These were the responsible savers. They held government bonds, the safe asset of the era, and kept their marks in savings accounts. They believed in the system. When the hyperinflationary spiral hit, the wealthy, who owned factories and foreign assets, and the speculators, who used debt to buy commodities, thrived. But the savers, the people with the equivalent of a traditional IRA, were liquidated. Their fortress was built of paper, and it burned with the currency. The lesson is brutal. When the monetary system fails, the safe path becomes the most dangerous path. The U.S. trajectory, the event horizon. As we look at the U.S. in 2026, the forensic indicators are flashing red. We have crossed the fiscal event horizon, exceeding 120%. Interest expense, now a top-tier budget item, surpassing the cost of the entire military. 10,000 baby boomers retiring every day, shifting from net savers to net sellers of assets. When a government can no longer pay for its past debt and its future entitlements through productivity, it must resort to financial repression. This is why the blueprints provided in chapters 1 through 5 are not optional for the historian. They are survival requirements. The state needs your IRA to be a traditional account because they need the tax revenue. They need you to hold bonds because they need someone to buy their debt. Building a fortress means intentionally making your wealth useless to the state's mismanagement. The final checklist, your sovereign perimeter. To conclude this blueprint, you must audit your perimeter against this final forensic checklist. Tax bracket immunity. Have you maximized your Roth bastion to prevent the IRS from being a majority partner in your future? Asset integrity. Have you moved beyond the 60/40 grave into productive equities with pricing power? Counterparty independence. Does a portion of your wealth exist in a self-directed perimeter held in physical hard assets like gold or real estate that the digital grid cannot delete? Geographic and jurisdictional moats. Is 100% of your wealth dependent on the political stability of a single jurisdiction? A call to financial forensics. The independent financial historian does not offer hope or optimism. We offer autopsies and patterns. The pattern of the 21st century is one of massive wealth transfer from the uninformed to the prepared. The IRA blueprint is not a get-rich-quick scheme. It is a structural reinforcement plan. It is the recognition that the wind is picking up, the tide is going out, and the social contract of the 20th century has been shredded by the printing press. You have two choices. You can continue to trust the blueprint provided to you by the entities that are currently $38 trillion in debt, or you can build your own fortress. History doesn't care about your feelings, your politics, or your hard work. History only cares about positioning. The currency clock is at 11:59. The data is in. The autopsy of the old system is complete. Build your fortress before the gates are locked from the outside.